Let's quickly revise accounting standard to valuation of inventories. Objective of this standard is to help us identify the value of inventories to be taken in evaluation of financial performance and also to evaluate financial position of an entity. The scope of the standard is given in paragraph 1, which tells us what are the items for which accounting standard to valuation of inventory is not applicable. It says it is not applicable to WIP arising in construction contract. It will be regulated as per accounting standard 7. And for WIP arising in service contracts, for which revenue has to be recognized as per accounting standard 9. And for service entity, there is no inventory. If inventory itself is not there, what is AS2 doing there? Nothing. Then we have shares and debentures. For shares and debentures and other financial instruments, we won't apply accounting standard 2, because even if you are trading them, it is not your inventory. It has to be regulated as per the specific standard issued, which is accounting standard 13, which specifically talks about investment accounting. It doesn't matter whether it is share or debenture, whether it is equity share or preference share. Further, standard talks about certain items which are not covered under inventories, like livestock, forest and agricultural produce, mineral oils, ores, etc. These are all producers' inventory. What we call them? These items are not under the purview of accounting standard. In fact, these are not under purview of any accounting standard. When we discuss 10 also, we'll tell that these are not covered under accounting standard 10. So then how do we value them? Paragraph 2 of the standard tells that we can value these items at net realizable value. However, there is no specific standard applicable. Inventories like livestock, forest, agricultural produce, mineral oil, ores and gases will be valued using industrial norms. Going slightly ahead, paragraph 3 of the standard helps us identify the definition of inventory. As per the definition of inventory, there are three items: finished goods, work in progress, raw material. These three are covered as inventory. Finished goods are such items which are kept in the active business for the purpose of sale, which are held in the ordinary course of operations for sale. Work in progress are such items which are in the process of being sold, in the process of being converted to finished goods. When it becomes finished goods, it will be sold. Lastly, we have raw material which will be consumed in the manufacturing of finished goods. In a manufacturing entity, we'll have raw material, work in progress, and finished goods. If it is not a manufacturing entity, if he is a trader, he will not have raw material, work in progress, he'll only have finished goods. However, if he is into manufacturing, he'll have three variants of inventory: raw material. For example, in a shirt industry, cotton is raw material, cloth is work in progress, ready-made product shirt is finished goods. Further, paragraph 4 of the standard says what are certain items which are actually not covered under the definition of the standard, para 3. However, these, though they don't qualify the definition of inventory under para 3, still accounting standard 2 is applicable to them. We'll value them as an inventory, we'll record them like inventory. What are those items? Material supplies, consumables, and tools. So these three, though they don't qualify the definition of inventory as per para 3, still they'll be valued like inventory as per accounting standard 2. Next, measurement. How do we value all of these items? This is given in paragraph 5. Paragraph 5 of a standard is a very important paragraph and very generic line. It states that inventory should be valued at cost or net realizable value, whichever is less. In this context, what is cost is going to be major part of our discussion in this. However, NRV is not too detailed. I'll tell it to you right now NRV and then go to cost. Actually, the order is first we would have to learn cost and then learn NRV. NRV is net realizable value. That is sale value less selling expenses. Realizable value is sale value. Net realizable value is not sale value. Selling price or sale value is realizable value. It is gross in nature. When we say net, we need to deduct all such expenditure which is incurred to make that sale happen. Transfer expenses, brokerage, commission, or any other expenditure which is incurred for the sale to happen. So selling price minus selling expenses is net realizable value. We will value the inventory at cost or NRV, whichever is less. Reason is conservatism. If you have some inventory, though it is not sold, if its price has gone down, and if you are expecting to incur loss when you sell it in the future, such loss has to be booked immediately by way of conservatism. You don't have to wait for actual date of sale to record such loss. Record it right now. How? In the closing stock, when the value decreases, imagine your trading account credit side value decreasing, trading account debit side value decreasing, GP will immediately decrease. Hope you people are getting this. Talking about cost, what does cost include? Cost includes three items. One, cost of purchase, conversion cost, and other directly attributable expense. Cost of purchase. Cost of purchase will include purchase price, duties and taxes. Duties and taxes like GST, central excise duty, or custom duty, entry tax, anything that you pay. Should we include them or should we not include them? Depends whether input tax credit is available or not. If input tax credit is available, then you will take the input tax credit. Why do you add it to the cost of inventory? Don't add it to the cost of inventory. Take the cost of inventory as purchase price after deducting duties and tax. However, if input tax credit is not available, you purchase from an unregistered dealer in or you for it's a blocked credit, or for some other reason if input tax credit is not available, in such case such amount of tax paid will form part of the cost of the inventory. I hope you got that. Then any freight expenditure, that is travel expenditure or transportation expenditure in any form incurred for bringing the goods from the place of purchase to the place of, so such freight expenditure is included. Any other directly attributable cost that you incur will be included if it relates to the value of the inventory, if it adds value to the inventory, if it is mandatory to be incurred to bring the inventory to the place of sale. One item has to be deducted, trade discount, if any allowed by the supplier, you deduct it. If there is cash discount, what will be attained only and only when you make the payment, that should not be adjusted. That will go to P&L account. So if say, let's say the price is 1 lakh rupees, cash discount of 5,000 is allowed. Inventory's cost is 1 lakh. That 5,000 don't deduct it from 1 lakh to make it 95,000. Inventory value is 1 lakh, 5,000 rupees discount received will go to P&L account credit side as income. Cash discount doesn't decrease the value of inventory, trade discount does. Then we have what are the costs of conversion? Expenditure incurred to convert the raw material from, expenditure incurred to convert the inventory from raw material to finished goods. This can be categorized into two: variable, direct, indirect. If it is direct, it is direct material, direct labor, direct expense. Directly related to the inventory, in fact, you will have the per unit data available included at the per unit rate into the inventory. However, if it is indirect in nature, it can be further classified into two major classifications: variable overhead, fixed overhead. Variable overhead is such overhead which varies with the level of production. Higher the production, higher the overhead. Lower the production, lower the overhead. So here per unit data will be available. Total overhead divided by number of units produced. That will be allocated to each unit produced. That's not at all difficult. The beauty opens up when it is fixed overhead, meaning irrespective of the level of production, the expenditure is fixed. Whenever there is fixed overhead, that is expenditure is fixed irrespective of the level of production. What do we do in such case? Then compare normal production with actual production, or normal capacity with actual capacity. If the actual capacity or actual output is equal to or lesser than normal capacity, then total fixed overhead is divided by normal capacity. I repeat, if actual capacity is equal to or lesser than normal capacity, total fixed overhead is divided by normal capacity. However, if the actual capacity is more than normal capacity, then scrap this normal capacity, deduct the total overhead by actual capacity. Why? In costing, we have a concept of under absorption, over absorption. Accounts, we don't. There is no concept of over absorption in accounts. You cannot make profit on the expenditure incurred. So we charge the total expense based on actual units, because our estimation of capacity has gone wrong is what we believe in. And in costing, you adjust it with standard costing, adverse and favorable. Here we don't do that. Here we charge it to the inventory totally. If the actual capacity is more, we don't overcharge. If it is less, we'll check. If it is less, then such unused production capacity should be charged to P&L, not to the inventory. So that is the reason we do it based on normal capacity when actual capacity is less. However, if actual capacity is more, charge it based on actual capacity, not on normal capacity. Then we have other expenses. Any other expenses which is incurred to bring the goods to present location and present condition should be included in the value of inventory. That's what other cost paragraph says. Then what costs are excluded? Certain costs are specifically excluded. Number one, abnormal loss. Abnormal loss and normal loss are different. Loss which can be mitigated, loss which can be avoided, loss which can be controlled by taking specific measures, or normal loss. Loss which cannot be controlled. Loss which cannot be controlled, cannot be mitigated, or not in our control, or normal loss. This has to incur. We can't stop this loss. But loss which can be controlled, which can be mitigated, which is something within our control. If we follow correct measures, we won't incur such loss. That is abnormal loss. Normal loss, we can't do anything, no. So what do? We'll adjust it in units column only. Whenever we adjust normal loss, total value will be same for lesser number of units, because of which per unit cost will go up. So normal loss increases the cost per unit. Normal loss increases the cost. However, abnormal loss, we're going to deduct it in units column. We will also deduct it in amount column, because of which the cost per unit in the case of abnormal loss will remain same before and after. I repeat, in the event of normal loss, units are only deducted, value is not deducted, because of which per unit cost will increase for the good units remaining after normal. In the event of abnormal loss, number of units is reduced, value assigned per unit is also multiplied and written in amount column, because of which total value will also reduce, because of which what's happening, there is no increase in per unit rate, per unit will remain same. Such an amount what is there for abnormal loss should be charged to P&L, it will not be charged to inventory. Normal loss, I told total value will be same, per unit cost will increase. So normal loss is included, abnormal loss is excluded. What about storage cost? Any expenditure incurred to store the inventory at one place, this will not increase the value of inventory unless it is part of the production process. For example, timber, rice, wine, you have to store it to call the product complete. So then the storage cost will be included in the cost of the inventory. Otherwise, storage cost is not included in the cost of the inventory, that should be charged to P&L. Any other administrative overhead, selling and distribution overhead, which is incurred in the ordinary course of operation, should not be charged to inventory. I hope this made sense. Then, talking about valuation techniques, we have several valuation techniques. You would have learned this in your CA Foundation, chapter 4. If the units are ordinarily interchangeable, one unit can be replaced with another. Then, considering historical cost, we learnt in foundation that we have FIFO, LIFO, SAM, and VAM. But AS2 says you can either follow first in, first out method or weighted average method. These two methods can be followed if ordinary items are ordinarily interchangeable. One product can be exchanged with the another, and we are considering historical cost. If we are not considering historical cost, for example, we're doing business in FMCG sector where number of units involved is huge, value per unit is very less. There we follow adjusted selling price method. We'll identify the closing stock at selling price, eliminate the profit margin from this. That will give us closing stock at cost. Or standard cost. Standard will fix cost price per unit, multiply with number of units that is there. That itself is the cost price of the closing stock. Standard cost method or adjusted selling price method. If we cannot replace one product with another, if the business is like customized clothing apparel or jewelry, all of this, one product cannot be replaced with another. There we should go by specific identification method. For every unit of inventory, we need to specifically identify the value of inventory. We cannot skip. Are you getting this? This is with regard to valuation techniques. And next comes to the part where what if in one production process more than one product pops out? We'd have to check whether the product that's popping out is a joint product or a byproduct. When do we call it joint product? When do we call it a byproduct? If the product has commercial viability, it has commercial value, it is material, it is joint product. If not, it is immaterial. It has no commercial value. It doesn't, you didn't have an intention to manufacture it. You are ready to throw it into that gutter. Then it is byproduct. Get this? Whenever it is joint product, the cost that you incur in the entire production process has to be allocated to both the joint products. How do we do it? If that expenditure is incurred after the split off point, after you split and then started processing both the items separately, then you have separate costs, allocate that cost to them. If this expenditure is incurred before split off point, that is when the processing is happening together for both the products, that has to be apportioned to both the products. How do we do it? In a common basis which is reasonable and viable and logical. That reasonable, viable, logical basis is sales value. That sales value can be taken for joint products at the time of sales, at the time of split off point, or at the final point of sale. Wherever it is more clearly and evidently available, such sales value will be taken, not sale units. Sometimes one joint product sale value is high, number of units is less. One more joint product, sale units is more, value is less. So we should take number of units multiplied by selling price per unit value of two joint products. In that ratio, we apportion the joint cost incurred for both of them. If it is byproduct, there is no separate valuation for byproduct. It is valued at NRV, net realizable value. And this net realizable value of the byproduct will be deducted from the cost of production of the total main product. This is if the byproduct is immaterial. It's called as a byproduct when it is immaterial. After some time, I told you a beautiful example if I remember that cocoa powder and yeah. So if in case this byproduct ends up becoming a material product, so then don't treat it like byproduct. Treat it like joint product. Allocate cost to it on a reasonable basis. You get that? That's with regard to joint product and byproduct. How do we value raw material? How do we value finished goods? Valuation of raw material actually depends upon how do we value our finished goods. If finished goods are sold at cost or above cost, then finished goods are valued at cost, and then raw material is also valued at cost. If finished goods is sold below cost, then finished goods will be valued at NRV, because finished goods is sold below cost. No, NRV is lesser than cost. Finished goods will be valued at NRV. When finished goods are valued at NRV, finished goods are sold at loss. Raw material might be sold at loss. Raw material, you are not having a proper intention to manufacture a finished goods. Then what do? Then our raw material will be valued at cost or NRV, whichever is less. However, if NRV of the raw material is not available, we'll take replacement price of the raw material as the reasonable. How do we value our work in progress? Work in progress, there is no active market. Cost incurred for work in progress plus cost expected to be incurred to complete it. If we add, we get the total expected cost when it becomes finished goods. Compare that with NRV of finished goods. Take whichever is less. If whichever is less turns out to be cost, then you know what's happening? Finished goods will be sold at profit. So you have proper intention of manufacturing work in progress into finished goods and sell it at profit. Profit will be recorded only when you sell. Conservatism. So value work in progress at cost. Value work in progress at. However, when you take the work in progress cost incurred plus cost to be incurred, you will get the total expected cost and you compare it with NRV of finished goods, then you get whichever is less is NRV. Meaning this work in progress, when it becomes finished goods, it will be sold at loss. Conservatism, we have to book that loss now. What do? That loss has to be deducted from cost incurred. That will be the value of WIP. That will be the value of. Alternatively, you can take NRV of finished goods, deduct the cost to be incurred on WIP. You will get the same answer. Either of the approaches, if you follow, you will get the same valuation of WIP. So read this part once again. This is slightly tricky. Then can we reverse reverse the writing down? We have written cost or NRV, whichever is less to NRV. NRV which is lesser than cost. Can we reverse it? Yes, we can. If the conditions prevailing because of which NRV was lesser than cost have reversed. Such economic condition has reversed, we can reverse and restore the value of inventory to cost, not above cost. Inventory cost is 100, NRV is 80. So because of some reason, some downfall in the market, some lack of demand, we valued the inventory at 80. Next year, if such economic condition has reversed, we can take the value of the inventory back till 100, not for a price more than 100. This is a quick revision on accounting standard 2, valuation of inventories. Got it?